Good afternoon. My name is Jason Brown, and I'm the Director of Advisor Success here at Foster Group.
And I'm Kent Kramer, the Chief Investment Officer at Foster Group.
And we want to give you a warm welcome to today's webinar, which we've called Navigating the Proposed Tax Changes. Today, we're going to be looking at the American Families Plan and the American Jobs Plan. And we're going to talk through some of the changes that we think will affect the majority of the people listening and watching. We'll talk through maybe the implications for the plan and the portfolio. We'll also talk about how this could impact you directly at the end by focusing on things that maybe we think you should pay special attention to. We'll also be joined by a couple of our colleagues today. So Stacy Nusendorfer is a senior lead advisor out of our Omaha office. She has her JD in addition to her CFP. And she spent a lot of time helping people with estate plans. And then also Zach DeLee, who's a senior associate, and he spent time helping the Iowa legislature. So before we get started, there's a few housekeeping items I want to go through with all of you. The first is this. This webinar will be recorded, and you will be sent a link in the days following it. And then it's going to be lasting about 30 minutes with a live Q&A at the end with Kent and I. If you've got questions, you can hit the Q&A button down at the bottom, and you can write down questions anonymously. But if you want us to make sure and answer them or get back to you on those, it'd probably be best to include your name. And any questions that we don't get to during the webinar, we will get back to you on afterwards. And with that, let's get started. Zach, you're one of our resident experts here on tax law changes. So talk us through some of the proposals of the Biden administration.
Yes, there's two primary proposals. One that's gotten a ton of attention is the American Jobs Plan that's focused on infrastructure improvement. What we're actually going to focus on today is the American Families Plan. And the reason for that is the changes in there are most likely to be the ones that are most impactful for our clients. So the three primary proposals within that, number one is the increase to the top marginal income tax rate. So that's currently at 37%, and that would increase to 39.6%. The next one is on long-term capital gains. Those would now be treated as ordinary income for taxpayers that make over $1 million in adjusted gross income. So currently there's a favorable tax treatment where the top rate is about 20%. That would increase to that ordinary income tax rate on long-term gains, again, for taxpayers with over $1 million in AGI. Third one, taxes on unrealized gains with over $1 million in gain per individual at death. So that would be on, think of like real estate, stocks and bonds that are not in a retirement account. If there's over $1 million in gain, that would then be treated as a taxable event, which Stacy will talk about here later. And then some of the other items, if you see the footnote below, there's been some other discussions such as lowering the estate tax exemption, entirely eliminating the step up in basis, a wealth tax, and even potentially taxing unrealized gains during lifetime. Currently, those items are not included in this bill. There's certainly been part of the discussions that are going on in Washington, but they're currently not in one of the proposals that we're going to discuss here today.
So Ken, let's talk about that first one, the increase in the top marginal income tax rate. And I thought when we were walking through this, you gave some helpful context for that change.
Yeah, you bet. I think, a couple of rates that Zach mentioned. One was the historical U.S. corporate tax rate. And I was thinking when we talk about changes in rates coming, helps to look backwards and go, where have we been? Is this a major change or not? There was a major change in the corporate tax rate in 2017. You can see that drop from kind of the mid 30s down to just above 20. So the idea there is, yeah, historically, maybe that is relatively low than where it's been. So the increase on that, I think while it may go back up, it's not going to affect, like Zach said, that many of our individual taxpayers. But just for some context there, if we look at the individual rates, so this one, I think, is a little bit more benign, actually. I mean, in 2017, the rate went down from 39.6 to 37. If you look at kind of top marginal rates going back in time, really from basically the late 80s, mid 90s, that rate has been right around that kind of mid 30s level for the top marginal rate. There's been significantly higher top marginal rates in the past. Obviously, those are set up for some very high income earners, and there was different public policy reasons for those. But the likelihood is, that adjustment to the ordinary income tax rates for individuals is just more incremental. It's going back to where we've been. Why I think that's important is when you talk about, well, what's been the result of these changes? The thing that struck me was, if you look at with all the changes in tax laws over the years, if you look at the actual tax collections as a percent of GDP, what you see there in that is that kind of federal receipts as a percent of GDP has remained remarkably non-volatile. I mean, right around that kind of just under 20%, so somewhere between 19% of GDP has been the federal collections, even with all the variation in those top marginal rates. So, historically, I think Congress and the executive branch have made some changes, but many of those changes affect total collections around the edges. One of the changes that they're talking about right now, and Zach mentioned this, is that change to the capital gains tax rate. And this one, unlike the ordinary income tax change, the change to this capital gains, long-term capital gains tax rate could be viewed as pretty extreme depending on what kind of taxpayer you are. So while we've been kind of trucking along here just under 25%, kind of in that favorable rate treatment for a long time for long-term capital gains, by taxing long-term capital gains at ordinary income tax rates for those highest income taxpayers, so the people at the 39.6% ordinary income rate, all of a sudden moving that long-term rate up equal to that, that is a big change, a big departure from history. And just kind of as an aside, remember that one of the reasons public policy-wise why we've had a lower capital gains tax rate is people wanted to have a free-flowing capital market. In other words, they wanted capital to be able to go from one place to another place based on the best use of capital. And if the tax rate on the sale of capital assets got too high, the theory is people wouldn't sell those maybe less efficient assets to invest in more efficient assets. So we wanted to keep that long-term capital gains rate a little bit lower so that capital would move around. This would just say, hey, for those highest income kind of bracket payers, we're going to raise that capital gains tax rate to be equivalent to that ordinary income tax rate.
So we want to focus on this one. It's more substantial potentially than the change in marginal top income tax rate.
Yep.
And Ken, I think it'd be helpful just to understand the rationale for why this is being proposed.
Yeah, you bet. Yeah, over the last number of years, we've heard a lot of conversations about who's paying their fair share of taxes, or at what rate should people be taxed. And again, historically, if we look here, you'll see that ordinary income tax rates, so the rate at which ordinary income, wages, salaries, those kind of things that appear like on a W-2, they get taxed at ordinary income tax rates. Short-term gains the same way. And they've always been at a higher rate than that long-term capital gains rate. So the blue line there shows the ordinary income tax top margin, and the red line shows the long-term capital gains tax rate. And again, we've given a favorable kind of treatment to long-term capital gains with the idea that we think economically it might be more favorable for capital to be able to move around freely. Kind of an unintended maybe consequence of that law, and this is where people have been focusing their attention, is, hey, a lot of the wealthiest people have moved or changed their financial circumstances so that instead of realizing their income as ordinary income, they're now realizing the bulk of their income as long-term capital gains. So what that means is a relatively wealthy individual can realize a bunch of income at a more favorable rate than a person who's making most of their income through wages. And this chart just shows how that works out. We're going to look at two individuals, very hypothetical in terms of how this works, but it's hypothetical. I think it makes the point really clearly. If we look at one taxpayer who makes $1 million of income, and it's all wages, all wage income or salary, When you get to the end of the year and you look at what they paid in taxes, all other things being equal, they pay about $298,000 in income tax. That excludes Social Security and Medicare tax. But the effective rate just on the income tax would be 29.8. If you include Medicare, it'd be over 30%. So that's the person making ordinary income only. Now, if we look at a taxpayer with a similar amount of, let's say, taxable income or AGI, $1 million of long-term capital gains instead of ordinary income. So this person, in order to get spendable income, they're selling assets to get $1 million in cash so they can pay life expenses or do other kinds of investing that they're doing. But the result is at the end of the year, when you calculate their tax bill, that $1 million of long-term capital gain income is going to be taxed at an effective rate of 15.8% or $158,000. I think this makes the point. If you have $1 million of ordinary income, that's going to be liable for almost $300,000 of taxes at ordinary rates versus a person who got all their $1 million of spendable income, if you will. That's being taxed at $158,000. That is a big disparity. And I think from a public policy standpoint, that's where the debate is happening, is can we make it so that regardless of how the taxpayer realizes their income, it's treated in a more equivalent fashion. And this whole story is where the anecdote with Warren Buffett and Warren Buffett's administrative assistant saying, well, Warren Buffett pays a lower marginal or lower effective rate than his administrative assistant. This is where this comes from. Warren Buffett realizes most of his income through long-term capital gains, whereas his administrative assistant realizes most of their income through wages or salary, so it's taxed at ordinary rates.
Now, I know, Stacy, you had something to add too.
Thanks, Jason. Just an observation to kind of piggyback on what Kent said. During our working years, most people save money through their employer-sponsored retirement accounts. And before we had things like Roth and Roth 401ks, that was traditionally in a pre-tax account. And so in doing all the planning that we do with clients and thinking about retirement, you could potentially have clients who, when they get to retirement age, all of their money or distributions is counted as ordinary income because Social Security is treated as wage income, assuming it's going to be there. And then when you have to take distributions from those traditional types of retirement accounts, that money has never been taxed. And so it is also going to be taxed at ordinary income rates. So you could potentially have a large number of people who get to retirement and all of their income is taxable at ordinary income rates because throughout their lifetime, they really just didn't have either the extra money to put into, say, an after-tax type of savings account that would be taxed at capital gains rate, or they just didn't even think about it. So that just kind of is another point in this disparity discussion.
So if something like this gets passed, Stacy, talk to us a little bit about some of the planning considerations.
Okay, so some of this, the legislation as proposed could be made retroactive back to April when it was brought up. However, I don't think the likelihood of that coming to pass is very great, although it is allowable under previous Supreme Court rulings. So if you think, that this is going to get passed, whether it's, going to be effective, well, if it's effective retroactive, there's nothing you can do about it. But if it's effective starting January 1 of next year, you may want to realize some gains now if you're sitting on a lot of gains. That would be a conversation to have with your tax professional if you have one to kind of help you strategically figure out maybe what would be not necessarily realizing 100% of your gains, but recognizing a portion of those. Other things to keep in mind, if you are perhaps sitting on a very large bonus that might be coming to you over a couple of years, or you are looking at selling a property or properties, something that is, or a business, something that is going to potentially push your adjusted gross income for 2021, up over that $1 million, you're probably going to want to strongly consider doing it this tax year versus perhaps spreading it out over 2 or 3 tax years. At the very least, put plans in place for that now so that if you need to pull the trigger, you can. Because if you spread it out or carry it over into 2022 or later, you're going to pay a bigger tax bill. And then finally, oftentimes we talk with clients about charitable gifting, and we really encourage folks to be charitable minded in their giving. But in this situation, it is probably helpful to know that making large charitable gifts is not going to reduce your adjusted gross income. Adjusted gross income is figured before charitable deductions, and charitable deductions are what they call a below the line deduction. So we want to encourage you to do that, but just know that it will not essentially save you from that adjusted gross income over $1 million number.
Well, darn. Ken, talk with us about some portfolio considerations for this change.
Yeah, so I'll just kind of keep going there where Stacy left off. I think the first thing I always encourage people is remember, for most of us, our investment portfolios are long-term kinds of assets. I mean, they're full of assets that really are designed to provide income for us or meet other goals that are beyond the next 2 or 4 years. So you want to be very careful to change long-term investment plans or to make long-term investment decisions based on what I think are near-term, and really the word is potential tax law changes. We know what's kind of been proposed in a few bills. We have really not a lot of ideas in terms of what actually would be passed. So you just want to be careful about thinking that you need to change everything, let's say, in light of this kind of potential near-term change. I will say this, though, in terms of 2021, the likelihood of rates being any lower in 22 or 23, probably not. If anything, the odds are that those rates will be higher. So if you are planning on selling some things or needing to sell some things to create some spendable assets or some spendable income, you may really want to consider doing that in the next, by the end of 2021, because the likelihood in the next 2 to 4 years is, if anything, rates are going to be the same or higher. So rather than waiting and running that risk, I think in the next 2 to 4 years, you just may want to look at 21 as your year. Now, I say that, and what that means is these last 2 bullets here become kind of important, because if a lot of people think that way, well, then there may be some volatility in the market as we approach the year end. Because if a number of people start thinking about, well, I may need to sell some things now in advance of 2022, the market could see some selling pressure between now and the end of the year. That creates volatility because this additional selling pressure could cause prices to go down. Of course, on the other end of that is people look at that and go, well, I'm going to buy on the dip. So the likelihood of market volatility, and as those tax policy changes are discussed and hypotheticals are discussed, it just creates a lot of, I think, uneasiness and a lot of stories in the media that are designed to create fear and gain attention. The other thing I'd say too is, hey, if the corporate tax rates are going to go higher, corporations are going to have to adjust their earning estimates going forward. That too may look like a negative for the stock market in the near term as they adjust those estimates. But again, remember, they're just making estimates about what their future earnings are going to be. They're going to do everything in their power to keep their earnings relatively high, but they're just going to have to adjust those estimates lower, because all other things being equal, if taxes are higher, they're going to have a little bit less net income.
So I want to move us on to the other proposed change that we really want to focus on today, which is the change to how unrealized gains are going to be taxed. And Zach, remind us again of, what is that change? And then also just maybe some of the challenges of implementing it.
Yeah, so the important thing here is to understand how the tax code currently works when you inherit assets that have had gain. So, say you were to go out and buy a stock for $50, and through that time that you're holding it, it doubles, it increases to $100. If you were to sell that, you would pay gain on that $50 of gain. So if instead, that person were to pass away and pass that asset to their heirs, they would inherit it at the basis of what the value was when they inherited it. So again, bought at $50, increased to $100, passes to the heir. If that heir were to turn around and resell that stock for, say $110, they would only pay gain on that $10 of gain above 100. So what this change would do effectively is it keeps safe about $1 million worth of gain. So up to $1 million of gain can pass to an heir without any taxable event. But if there's over $1 million in gain, then that would now be taxable immediately when it's inherited by the heir. So one of the key issues with that, or one of the key administrative things that need to be worked through, is what happens when there isn't good record keeping and you don't know what that basis is. So if assets were to pass to an heir and you didn't have record of, and were able to prove to the IRS what that cost basis was, the IRS is going to assume that's zero. So there could potentially be a big tax impact on taxpayers that don't have good records of what those assets are worth. And I think, some of the key things where that could come into play is in real estate, is in farmland, and is in more legacy investment accounts that record keepers of investment accounts weren't required to report and hold that tax basis until about 10 years ago. So assets that have been held for a long time, it could be difficult to find that cost basis, and it'd be very important going forward to make sure to continue to track that.
I know I would have trouble with some of my assets back. So now, Stacy, what are some of the planning implications again for this change?
As Zach mentioned, there is the step up in basis would be limited to gains that are realized over $1 million. Traditionally, when a couple and one of the couple dies and the surviving spouse is subject to no tax typically, because we have the full step up in basis, and there's other taxes that, such as estate tax and inheritance tax, that spouses are not responsible for either. In this situation, a spouse is not protected. If, let's say, a wife survives her husband and there are appreciated assets totaling $2 million, she is responsible for $1 million in capital gains tax on that. And the reason being is we have some new realization events with this legislation, and death is one of those. So when the account owner dies, that death triggers immediate realization of the gain in that asset. So anything over $1 million is taxable. Doesn't matter who you are as the heir. One nice thing is spouses do have portability between them. So if spouse number one dies and only uses $500,000 of that $1 million gain, surviving spouse will then have her $1 million plus deceased husband's unused $500,000. So there is some portability there. But again, a big change. Along with those realization events. So we have death, another one, gifting. So now, currently, if I were to make a gift of stock with a basis of $10 to, say, my son, and then he sells that stock for $100, he would realize $90 of gain because it's carryover basis. Currently, but if he continued to hold it for several years, he wouldn't recognize that gain. With this new realization of gifts being an event, anytime a gift is made, that embedded gain is immediately realized. So gifting to, a share of Disney stock to your grandson or granddaughter might not be such a nice gift. And then finally, trusts after 90 years. So trusts can hold assets for decades upon decades. That's a whole different estate planning discussion. But essentially, with that length of a trust, the assets inside from a capital gains perspective can go untaxed for very long periods of years. Right. With the new realization event, it is saying that trusts after 90 years have to realize those built-in gains. And it is not 90 years from the date the trust is drafted. So if you draft a trust this year, it's not 90 years plus 2021. This is actually retroactive back to 1940. So that would mean in 2030, just 8.5 years from now, those trusts would have to realize all the gains that have basically gone untaxed within that trust. So lots of changes. The best thing I can suggest that you do is, if you have an estate plan and an estate planning attorney, please visit with him or her to see if there are any changes that you should make. There's a variety of techniques and things that can be utilized out there for the potential lowering of the estate tax exemption, would also then lead into some of these capital gains issues. If you do not have an estate plan, I can't encourage you enough to please do that. This past year has shown us the importance of having your so-called affairs in order, not only having, you know, your will, but maybe a trust, but also really those powers of attorney and healthcare directives. So, you know, I always say it's important to visit with your estate planning attorney when thinking about making changes. Estate plans are extremely tax driven, and we've got so many things circling around like we do now. It certainly merits a call to your attorney to discuss them. And again, if you don't have an estate plan in place and you think you're potentially going to be realizing some of these changes, make a call. If you need a referral, we're happy to help you find somebody who can help you.
That's a bit of a PSA from our resident JD on staff as well there. So thanks.
Oh, Jason, I'm sorry. One last thing that I was remiss and I really needed to mention. In the Midwest, we have a lot of farmland. It's a really hot button for families. There are exemptions in this legislation for family-owned farms and small businesses. So just know that when somebody dies, that is not necessarily a recognition if you own a farm or a small family-owned business, as long as it continues to be owned by family members. So that realization event would occur if it is sold to someone outside the family.
Now, Kent, we want to talk a little bit about the process for these changes actually happening. You know, we've talked about this before. You had a ringside seat when you were a member of the House. Act 2 has been involved in the state legislature, but talk to us about that process.
Right. Well, I think what Stacy just said there at the end about exemptions already being built in. So, you know, that's the thing about making legislation. The process is a bit like sausage. People talk about it. You might like the end result, but you maybe not watch the process too closely. You might not like it. And what happens when big bills like this start to move is everybody's kind of saying, well, this might work or this might not, and trying to understand where each congressperson or senator is at in terms of where the votes are becomes really, really important. And I think in this first bullet that the Democrats as a whole, they're going to have to find kind of enough middle ground where their entire caucus can support it, because the new word of the day, I think if you watch Washington, is reconciliation. That idea that if we can make a bill qualify for reconciliation, it can be passed with a simple majority in the Senate, which means if you can keep all 50 Democrats and the vice president, then you can pass without any Republican support. However, in legislation this broad, especially with an election coming up in 2022, there's going to be a lot of desire to try to make this bipartisan, or at least to make it appear reasonable. And so I think they're going to probably do maybe less than advertised. Like a lot of bargaining situations, you set out kind of an extreme position at the beginning, knowing that you're not going to get all of it, but you're going to get some. And I think that's likely what happens here. The debate will move towards the middle because people want to win elections in 2022, and it'll be important that it looks like everybody wants to do what's best and not necessarily just what's the most extreme. The other thing I'd say is, hey, tax laws change all the time. We will have an election in 2022. The entire House will be up for re-election. That's hard to imagine at this point. I feel like we get kind of election fatigue, but it's coming back around. The Senate will go through some changes as well. And with those changes, the result could be further tax law changes. We just had major changes in 2017. Nothing saying it can't happen again. And I close with this. Zach will like this one too. The word notwithstanding is the legislator's favorite word. If you're drafting a bill and you put the word notwithstanding at the front of it, what you're saying is, notwithstanding any law that came before, replace it with all of this new one. And so the ability to change the law as each kind of legislative period changes, it's a live ball every time based on the majority and kind of what the will of the country is at the time. Things can change. The good news is they don't necessarily change in a knee-jerk, super rapid fashion. The founders are smart enough to make it so that you have to have enough people on board that things tend to change more incrementally, but things do change regularly. And that's why people run for elections, because they want to make changes.
So maybe what would you anticipate actually changing when we get through the end of whatever process we go through? What might be some actual changes to anticipate?
Yeah, really good. I think the top marginal rate going back to 39.6, as we saw before, that one changed from 39.6 to 37 in 2017. It's not a dramatic change to go back to 39.6. The economy was humming along just fine at 39.6. So I think that's probably really likely. Corporate taxes increasing a bit. I think that's also likely. Whether it goes all the way back to 35%, the government, the federal government, they want to keep U.S. corporations competitive, and they want to keep them domiciled in the United States because that's where they're going to pay taxes, where they're domiciled. So they're not going to want to raise the rate so high that corporations begin to offshore again. So I think somewhere kind of north of where it is now, but maybe a little bit less than where it was previously. Long-term capital gains rates, I certainly think there's lots of momentum behind those rates increasing. The likelihood of them going all the way to ordinary income tax rates, especially for most taxpayers, pretty unlikely. Will they go higher for high income people? I think that's pretty likely as well. Yeah, the estate tax planning thing, Stacy touched on these. The current estate tax exemption amount, it's scheduled to sunset in 2025 anyway. I think it's better than a 50% chance that they would just go ahead and sunset that now, kind of reduce that exemption from 11.7 million per person to maybe 6 million, something like that. And then that some form of carryover basis or that loss of step up in very large estates. Again, as Stacy mentioned, there will be exceptions and all kinds of rules with that, but the pressure to find some way to tax assets that have genuine gains in them, but in the past have escaped taxation because of current estate tax laws, I think there'll be some momentum to try and make those assets, at least to hold on to the carryover basis. So whoever does ultimately sell the asset will be liable for the tax on the gain. They wouldn't necessarily have to pay the tax immediately on just taking possession of it as in a gift or an inheritance. But if they do inherit it or get it as a gift, and then they choose to sell it, at that point, when they choose to sell it and there's actually liquidity, so they're receiving cash, they have a means to pay the tax, I think it would be likely that something like that would come into play.
Well, I want to thank all three of you for doing this webinar. It was very enjoyable for me to put it together with you. I learned a lot and also really appreciated the conversation today. So thank you very much.
Thank you.
Well, welcome back. Kent, I always feel like I learned stuff as I am prepping this webinar and asking these questions. So thanks to you, Zach and Stacy, just for myself. I know more than I did, 2 weeks ago, for sure.
I learn a lot in these things. I appreciate Zach and Stacy as well. They keep their eye on the ball there. So.
Yeah. I also want to apologize. I think some of you may have had a bit of a fuzzy feed going on, so I apologize for that. And that should at least be somewhat corrected when we send you the link to the recording. So, Kent, quick question that came in. The timing of these tax changes, like when would that happen?
Yeah, there's been some debate along the way here about whether things would be retroactive, meaning they would pass the law in 2021, and then any activity that you did in 2021, going back, to March or February, would somehow now be taxed under the new rules as opposed to the rules that were in place when you made the decision.
Yeah.
Historically, that has been a loser of a proposal.
I can't believe that'd be very popular.
Yeah, it just feels a little unfair to change the rules midstream. The idea behind it is, well, we don't want people to game the system before the end of the year. So they may, let's say something gets passed in October. They might say as of October, but most likely it'll be January 1st of 22 that the laws would come into effect. And that historically, that would be more in line with how tax laws.
So there'd be a little bit of time between when they're passed or made into law and then when they come into effect.
That's exactly right.
Okay.
That's exactly right.
Good. Another question, just what is the wealth tax? I'll ask it as well on behalf of the listener.
So there isn't one right now. Okay. So when we talk about a wealth tax, it's like there really isn't one today. The concept behind a wealth tax is to say, for some group of people who have an amazing amount of money, whatever your definition of an amazing amount of money is, let's say it's $100 million. They would say, well, on that $100 million of accumulated wealth, we want to just tax you at 1 or 2% of the total assets that you have. whether or not you sell any of them and realize any capital gains, regardless of what your income is. They're just looking at taxing accumulated wealth. We don't have that today. That would be kind of more at the extreme end of the proposals in terms of where things are going. I think there's a lot of headwinds against that one, especially with estate taxes where you can kind of get at that if you need to.
Yeah. So we closed by talking about what we think are the most likely changes to happen.
Right.
And I wonder if you could give us your odds, if you handled some of them individually.
Yeah.
What would the odds be?
So, when I talk about some of these things, I like to tell people, well, when it comes to this, I'm kind of like 60-40. And what I mean by that is, well, in this case, I think there's maybe a 60% likelihood that this happens, 40% that it doesn't, because the idea that anybody is 100% sure that any of these things are going to happen as they're being talked about today, I've just watched enough legislation over the years being formed to know that right up to the last minute, there will be some horse trading going on in terms of who gets what and what compromises are made. So until it's actually written in the bill, signed by the president, put into the Federal Register, it's like, I'm going to hedge on that. So with that disclaimer, let's just say most likely 60-40 here. I think maybe even more than 60-40. Again, that top marginal rate for ordinary income going back to 39.6. Again, I just think that's going back to where we've been just 2 years ago. That seems an easy one to make. I think having some increase in the long-term capital gains rates for certain high income taxpayers, there seems to be a lot of momentum behind that for the reasons we talked about in the differential in rates between ordinary income and long-term capital gains. So I would look for something like that. I do think it's a little bit less likely that it goes all the way to being equivalent to ordinary income tax rates. That would be just a total departure from the way that we've treated capital gains for decades in terms of differentiating between ordinary income and the movement of capital. So that one to me is less likely. I think another one maybe would be this idea of changing the rules around the step-up in basis for inherited assets. How that would work, as Zach mentioned, there's kind of proposal now to say, well, the first $1 million would be taxed differently in an estate than amounts above that $1 million. But the idea there is for a cost basis, let's say an asset that a parent has acquired, let's say they just bought some stock at 50, and at the time that they passed, the stock was worth 100. When the inheritor, let's say when the child gets that stock now worth 100, currently the step up in basis says, oh, you as the child, your tax basis is now 100. So if you sell it, you'll owe zero in capital gains.
That's how it currently works.
That's how it currently works, which kind of means that long-term gain that the parent had been accumulating since, let's say they bought it at 50. So there's $50 in accumulated gain that actually escapes taxation under the current step up in basis rules. I think the likelihood there is they're going to look at that and say, well, it feels like that gain should be taxed at some point. I think the easiest way to tax it would be to do away with the step up in a way. And then when the inheritor chooses ultimately to sell the asset, when they create a liquidity event. So it seems unfair to tax someone on receipt of something if it's let's say it's a business or farmland, because they don't have liquidity to pay the tax unless they sell the thing. If they choose to sell it, now there's liquidity, cash. And so the idea of paying the tax on the gain, I think that's more reasonable expectation. Now, the record keeping on the original basis, good luck with that one. That's going to take some changes for some people. But I think the idea for the likelihood of a change in the step up rules
is pretty high.
I think it's pretty high. I think the taxation of unrealized capital gains during the lifetime, in other words, if you have assets that are appreciating and you're not selling them, I think that's probably less than 40%. If my 60-40 analogy there, that just seems a little penal. And the taxation of all gains at the time of death for the same reason, that just seems like you're forcing people to sell family assets in order to pay the tax. That just seems less likely at the end of the day.
And as we think about these changes, what are the income levels or maybe the level of capital gain at which currently the proposals would say that these changes would affect these people?
Yeah, that's a great question. because everybody who's kind of been listening to President Biden talk about this from before he was president, when he was candidate Biden,
Yeah.
his words have been, hey, I don't really want people who are making less than $400,000 to pay more in tax under these new rules than they were before.
Okay.
That's kind of the general theory that people are operating under. Now, there's a little bit of question as to whether he means $400,000 for a joint income, so like a family with two incomes, or whether that 400,000 is per taxpayer per income. I don't think there's been a decision
Yeah.
that's really clear on that yet. And I could be wrong on that. But it's not in any law yet, so I don't know. But that's the idea. So for those, just generally, the idea is people should have about the same tax burden until they get above $400,000 of taxable income.
Yeah.
That's for ordinary income tax rates kind of combined with capital gains. Now, the capital gains rates that we were talking about in the webinar, that increase really comes into play for taxpayers with an adjustable gross income above $1 million.
Okay.
So a much higher income threshold
Yep.
in terms of when that would kick in. And again, I find it unlikely, certainly be proven wrong, but the idea that long-term capital gains rates would become fully equal to ordinary income tax rates. I don't know if that's just great public policy, but
Yeah.
we'll see kind of how the numbers score out.
Right. I mean, one of the things you talked about in the webinar is you want to have it at a rate that allows for the movement of capital.
Yeah, I think for two reasons. One is you want capital to be able to move to more efficient opportunities, things that it can be employed. So let's just use green energy, for example.
Mhm.
If you want money to move into that and away from fossil fuel, then you want people to be able to sell assets
Yeah.
that maybe have long-term built-up gains in those fossil fuel assets to buy or to invest in green energy. Well, if you raise the long-term capital gains rate so high that the people who own assets don't want to sell them because the tax rate is too penal, then you're not going to get the investment
Right.
that you want in the new things we'd like capital to flow to.
Right.
So there's an efficiency argument there as well, I think.
That would super helpful, Ken. Thank you. And then we've got somebody who wrote in, they've got a lot of gain built up in
Uh-huh.
their, after tax account.
Yeah. That's a
they-
good problem.
It's
Let's
a
start
good
with
problem.
that.
Right. That's a good
That's
problem.
a good problem.
Okay, it's good. So, and they also like giving. And so just a question about, is there anything I can do that can sort of like, maybe get around some of these capital gains
Yeah.
and satisfy my desire to give?
Yeah. Well, I mean, for us, this idea about generous living is a big part of Foster Group's kind of DNA.
Yeah.
We really, so applaud you for thinking about that idea, because certainly appreciated assets under today's rules are the perfect gifting asset. So the idea, what I mean by that is if you already have in mind that you'd like to do some charitable gifting, the things that you want to give away are those things that have appreciated greatly. Because the benefit is if you were to sell the asset and then try to give the cash away, you'd first have to pay the tax on the appreciated asset. If you give the asset to a charitable entity, they're going to get that asset at full value, dollar for dollar. And when they sell the asset, because they're a nonprofit under IRS code rules, they will not owe any capital gains so they get to keep the full value of the asset at the date of sale. Whereas if you tried to give them the asset, you'd be giving them the asset really net after you paid the tax on the sale. So yeah, absolutely. If you think about appreciated assets and a good use for those under the current rules, especially, but I think in the future as well, the idea of gifting away highly appreciated assets makes a ton of sense for people who are looking for ways to be generous.
Well, that's going to be it for our live portion right now. If you sent in a question and Kent and I didn't get to it, we will make sure that you get an answer.
Absolutely.
So as we wrap up, I have just a few items. So first of all, just a reminder that this has been recorded and you're going to be sent a link to this recording within the next few days. Secondly, for the clients that joined us, we want to say thank you and thank you for the privilege of serving you. And for any people who aren't currently clients of Foster Group, and maybe you want to talk about anything that we brought up today or anything else related to investments and finance, your personal plan, we would obviously love to sit down with you, and the information on how to contact us is on the screen. Finally, we like to do better and better with these webinars. So you've got an opportunity to do a survey following this. We would really just appreciate you giving us your candid feedback. That has helped us in the past make these better than they were. So again, thank you so much for joining us today. We look forward to the next time. Bye.